January 5, 2026. Global markets are navigating a high-stakes transition marked by geopolitical shocks and a shift in monetary expectations. U.S. market and sector movement. The S&P 500 finished the first week of 2026 with a 1% decline, retreating from all-time highs as 10-year Treasury yields climbed to 4.19%. Performance across the 11 sectors was uneven. Leaders, industrials and materials showed relative strength, up greater than 1.4%, buoyed by infrastructure optimism. Information technology and communication services remained the long-term drivers but faced short-term pressure from rising rates. Laggards, real estate and utilities struggled as the higher-for-longer rate narrative resurfaced. Energy remained volatile despite geopolitical turmoil. Global conditions and trends. U.S. focus is on Senonomics-style fiscal debates and a pending Supreme Court decision on tariffs. UK, the market is bracing for stagflation signals, with growth crawling below 1% and the 10-year gilt yield rising to 4.51%. Europe, the Euro Stoxx 50 hit record highs last week, supported by Germany's massive €1 trillion infrastructure and defense spending drive. Japan, the Nikkei surged 2.2% on its 2026 opener, driven by a weak yen and corporate reforms targeting shareholder returns. Here at the stock market performance playlist is this week's stock terminology learner. What is the UK 10-year gilt yield? The redemption yield, also known as the yield to maturity, gives an indication of the actual return on capital that the investor will receive from buying the gilt at the price shown and holding it to maturity. Gilts are UK government bonds, essentially IOUs where you lend money to the British government in exchange for regular interest payments, coupons, and the return of your principal when the bond matures. Named for their historical gilt edge certificates, they're considered very safe investments, funding public spending, and come in conventional, fixed coupon, or index-linked, inflation-adjusted types, forming a key part of the UK's debt. Top expected movers for exchange. U.S. Nvidia, sustained AI chip demand despite broader tech sector rotation. ExxonMobil, rising oil volatility and potential Venezuela energy sector reopening. UK, Shell, geopolitical risk premium in oil prices favoring energy giants. HSBC, higher for longer rate environment supporting improved net interest margins. Europe, ASML, global chip recovery and increased lithography demand in Asia. LVMH, improving luxury sentiment following China's aggressive fiscal stimulus measures. Japan, Toyota, stronger earnings outlook fueled by yen weakness and hybrids. Mitsubishi UFJ, monetary policy normalization in Japan boosting domestic banking profits. Anticipated news, week of Jan 5. The economic calendar is packed with labor data. U.S. jobs report, Friday, payrolls are expected to grow by 55K, amidst could trigger recession fears. ISM services PMI, to gauge if the 43-day government shutdown left lasting scars on domestic activity. Inflation data, Australia and China report CPI, which will dictate regional rate paths. Venezuela fallout predictions. The dramatic exit of Nicolás Maduro on January 3, 2026, has triggered a global race to collect. Debt crisis. Venezuela faces defaulted debt. A messy restructuring involves the IMF and aggressive vulture funds. Oil markets. While long-term capacity could return, immediate instability and potential fuel shortages in Q1 2026 may spike regional energy prices. Governance risk. A power vacuum poses the threat of a military junta or prolonged U.S. nation-building occupation. Help us to bring you the best content possible. Subscribe, share, like, and comment. This is the stock market.